I'm here with Chinh Chu, one of the most respected investors in the private equity world. We're going to talk about private capital. You also spent about 25 years at Blackstone, arguably seeing the rise of not only that firm, but the whole venue of private capital. Your old boss, Steve Schwartzman, notably yesterday at a conference, described the markets as, and I think this is a technical term that you've heard before, a barf burger. What do you make of all this volatility that we've seen over the last several months and certainly the last couple days?
First of all, thank you for having me on the show. Great to be here. I think Steve, when he talks about a barf burger, it's a very technical term, refers to anything over 500-point drop in the market. Look, we've had volatility in the market, and it used to be that the economy and jobs and earnings were the key things that drove the stock market. I think today, given the volatility, it's really politics, it's really other things like trade that are driving the market, and it's really the unpredictability of all these factors that cause a lot of volatility. And could there be decoupling of some of these things? Maybe. It's all related, I think, at the end of the day, but really the volatility is resulting from the unpredictability and other factors, not extraneous, but related factors, but not the key ones of jobs and the earnings power of the market.
Does that, as someone who's watched the markets for a while and valuations for a while, does that surprise you that the economy is maybe down the ladder, as it were?
It does, and I'm not sure it's a short-term trend. I think through the next few years, we're going to have that phenomenon that the economy is very important, but ultimately what drives the short-term volatility of the market may not be the jobs or the earnings of the economy.
So you talk to a lot of CEOs, you talk to a lot of investors. Again, you've been looking at the market for a long time. How does the economy feel to you right now? Even if it's less important to the broader market, how does it feel to you?
The economy feels okay to strong. There's not a lot of signs that the economy is weakening. If you look at corporate earnings, you look at consumer confidence, you look at any weakness in the economy, it feels pretty strong right now.
So volatility traditionally, I think you would agree, has been pretty good for private capital, private equity specifically. Agree, disagree? And is this a moment where maybe private equity comes even further to the fore?
Volatility in general is good for private equity. A lower valuation in general is good for private equity. However, it's a short-term volatility that may create freezing of the market in terms of deals because corporate boards and sellers may take a look at the last 52 weeks of valuation instead of what the current valuation is. And that gap in terms of their belief what the valuation is needs to settle down for 2 to 3 quarters before deals can get done. So extreme volatility can actually cause a slowdown in deals, but overall you're correct. Volatility creates opportunities for private equity, and overall if the stock market is lowered and valuation is lowered, it's terrific for private equity.
All right, so 2.5 years ago, you lead Blackstone after, as I mentioned, a couple decades of helping lead Blackstone, into being, the biggest name in private equity. What was the thought when you set out to create something different? Because you're not just hanging out a shingle as a traditional, quote-unquote, private equity firm.
Blackstone was a terrific experience. I was there since 1990. I've had the pleasure of working with Steve, being mentored by Steve, and helping build the firm. When I created CC Capital, I hope to build a different firm to focus on longer-term capital or permanent capital. I think ultimately some of private equity will move toward that trend, and investors and LPs are looking for capital that's longer duration. So we look for companies that can compound over a long period of time, high-quality companies that do not have to be sold within 3 to 5 years. And that's the main difference between CC Capital and some of the other private equity firms.
So how do you structure it? Because as I understand it, it's a little bit of a blend of some private equity elements, but also some public market elements as well, right?
So you're right, it is a hybrid. We do some traditional private equity deals. Recently we announced the Dun & Bradstreet deal, which is a $7 billion going private of a company that's a terrific company. It's 177-year history. And we think this is a company that exemplifies what I'm talking about. High quality fundamentals, strong moats, and a company that has significant upside, both on the revenue and the cost side. In addition to that, we raise pools of SPACs, special purpose acquisition vehicles. We've done 2 of these, that are public vehicles that are designed to buy companies effectively to take them public. Very different from a traditional private equity model.
And so, what's the attractiveness for an investor there? SPACs have been around for a long time, but and they're a fairly big part of the market. Probably underestimated how big they are. What's the attractiveness there?
You know, it's interesting. SPACs have been around for a couple of decades, but recently there's been a new generation of SPACs, SPACs 2.0. And starting from 2010, the market was revived. At that point, SPACs were about 3 to 5% of the market, of the IPO market. In the last 3 years, the SPAC volume is now over 20% of the IPO market. There's a lot more dry powder in SPACs. There's a lot more interesting issuers of SPACs or sponsors of SPACs. Private equity firms, in fact, have started to both sell to SPACs as well as sponsor SPACs. And people like myself, my partner Bill Foley, have done SPACs that have, I think, elevated the SPAC market ultimately.
And so, who are the investors there? Is it the traditional private equity investors, or are you widening the aperture a little bit to include other types of investors?
The traditional SPAC investors are mostly hedge funds, but today the market has been widened. So you have private investors, including some LPs of private equity firms, and very importantly, the mutual funds. So in our latest SPAC, Colliers, we've actually had a lot of mutual funds, traditional mutual funds that sometimes don't invest in SPACs. The largest investor in Colliers was actually T. Rowe Price. And so it's a very interesting change in the SPAC market where you have very high quality institutions investing in SPACs today.
Well, whether it's Steve Schwartzman or David Rubenstein or any of the other, Henry Kravis, any of the other sort of big name private equity guys, they talk about getting to that market, a broader market for private equity. That's the holy grail. Have you found the holy grail for retail investors to find a way into a private equity investing?
You know, I think SPACs don't particularly compete against private equity. There may be a little bit overlap, but for SPACs, these are companies that want to go public.
Okay.
These are companies that ultimately do not want the higher leverage and the private nature of private equity. So if you buy a company and put it into a SPAC, usually you have 2 to 3 times leverage.
Interesting.
Usually you compete against the IPO than really private equity.
Right.
And the SPAC's advantages are many. One, you can provide more liquidity for the seller than an IPO, usually 2 to 3x than an IPO. You can negotiate a deal with a fixed price, whereas IPOs, you're subject to the gyration of the market, whether the market's open or closed. You can do very, very detailed due diligence on a company and have actual projections. And the seller can either keep a majority or minority. So it's a very flexible capital structure at the end of the day.
Do you expect that this is a scalable business? I mean, how much do you expect your firm to grow to accommodate this opportunity?
I think it is a scalable market, and I think the SPACs are the SPAC is an asset class that will persist and will continue to grow because I think it's changing pretty rapidly. As I said, over 20% of the IPOs were done in SPACs. There's about $15, $16 billion of dry powders in SPAC today. This year, over $10 billion of new SPACs were issued. Now, it's still very much of a fraction of the private equity market. As you know, private equity dry powder is over $650 billion. But I think that market will grow. And private equity firms, including TPG, including Carlyle, are issuing SPACs as well.
Right.
Some private equity firms are selling to SPACs, and Fortune 500 companies such as Dow are also selling it to SPACs. So we think it's a growing market, and we think we're going to continue to do both SPACs as well as traditional type private equity deals, such as Dun & Bradstreet.
So before I let you go, I got to ask you a little bit about your personal story. It's fascinating. You know, you came to this country as a child from Vietnam. You have been very successful. I know you've given a lot of thought to your philanthropy. It's sort of that time of year when people think about those things. What's your philosophy there?
I feel very fortunate. I came here, as you know, as a refugee, and very, very fortunate to be an American, very fortunate to be in the business I'm in, and it's very important to give back. So we support a lot of charities around New York City. I'm on the board of City Harvest. We also build schools in Asia and in Africa and do a lot of healthcare missions. I think it's very important to give back, and it's a privilege not an obligation to give back.
And do you feel like that spirit is in Wall Street right now? It's a volatile time.
I think it is. I think Wall Street, and if you look at what Steve has done, giving to the public libraries, what a lot of my colleagues have done, I think it's a wonderful thing to do to give back, and I think it's alive and well.